Looking good.
Good.
Okay, so probably let me know when we're ready. Okay, I think we are live now.
Okay, excellent.
And then I think we are probably ready to start. Alan, are you ready?
Yes, anytime.
Anytime. Okay, great. Okay. Thank you everyone for attending our webinar today about bank bonds and capital notes. This webinar will cover a well-known but little understood instrument, that is a fixed income instrument, which demands a lot from our client and investors. So this fixed income area would including bonds, for example, and capital notes, also called hybrid securities. So and we'll touch. So what we'll do today. So within this half an hour to 1 hour webinar, we'll touch base on to answer investors' questions. Firstly, about what's in for me. So what's the benefits of the fixed income instrument, and how to understand the actual product. And secondly, what are the risks? So what need to be watched out for? However, of course, like there are a lot of information in it, and stay tuned. And I would love to introduce Alan Lin, Mr. Alan Lin, one of my really good friends from Candour Capital, to help us to do an educational webinar today about the bank bond hybrid securities, also called a fixed income instrument. Thank you, Alan. Thank you. I'll pass on to you.
Well, thank you, Jack, for the lovely introduction, and it's a great pleasure being here, taking part in the Tiger live stream webinar. Again, I guess we're probably going to start from a very high level in terms of what are bonds, how do they work in our capital markets, and then going down to specific, I guess, products that are available for the Australian investors. Okay, so when we talk about bonds, I think the part of the size of the market is probably not well known to many, that the global bond market total cap, in terms of the size of capitalization, is actually much bigger than all equity markets combined. The global bond market stood at the value of 133 trillion, based on the figure that published by Reuters back in February this year, and they continue to grow. And obviously, there's a large part of that, the bond capital markets being government bonds. And they take a big chunk of the size in the market share. But bond is really just a fraction in the total debt market. So I guess people probably think that bond and debt are interchangeable terminologies. In fact, they're not. So debt is probably a more generic word about liability in terms of obligation of one person owe money to the other. It may represent in an IOU contract. Okay, but when we talk about bonds specifically, it means that this debt obligation has been securitized. It has gone through a process of securitization, so it becomes a standard securities that become negotiable and transferable. When we say negotiable, means that there's a price that determined by the buyer and seller, and transferable means that it can actually change the legal ownership. It can go across different jurisdictions. Investors here in Australia, they can buy and sell bonds denominated in US dollars or issued by potentially a bank that from UK. So the bond is actually a security, is a form of debt that had gone through the process of securitization. So when we talk about bonds, it's something that they have a standard offering documentation such as prospectus, and they carry a ISIN number, and it will go through a standard clearing and settlement process. So you really need to, facilitated by financial institutions or professional brokers that to help you to buy and sell bonds. So bond is a fraction of debt. It's a process of securitization, and it's a security that being produced under the standard disclosure document. And then start to talk, you start to see that the bond carry different features, such as whether they're paying a fixed coupon or they're paying a floating coupon, or there could be a fixed coupon at the start and then change to floating coupon towards the later part of the term. There are different features where they could be hybrids or convertible. They are typically issued by corporations or companies, where you can convert your bond to equities. Obviously, you have different type of issuing entities, whether they're governments or supranational entities, such as a World Bank, such as Development Bank, and you have the companies and plus mortgage-backed or asset-backed securities that where you may often hear MBS or ABS, and different currencies. So that's why that there's a lot of varieties and from in different type of issues, different features in different markets and jurisdictions. Okay, so I think that investors are often, especially in Australia, that overlooked in terms of the type of the benefits that bond can provide. Is really more about giving investors a predictable cash flow or income stream into that I think is extremely important for someone that for example start planning for their retirement. So generally speaking, when we start looking in bonds, then you start to come across specific terminologies that are associated with bonds. So we just wanted to share a few examples here. Trade date and settlement date. This is also very similar to obviously our clients that use Tiger platform to trade domestic equities or international equities. Bond, when you buy and sell, let's say today, and today we'll call it a trade day. The settlement works in a very similar fashion as equities, that it happens in 2 business days time. So we call it T+2. So in the bond market, it also offers daily liquidities that where you can buy and sell in the OTC market rather than in an exchange traded environment, and it takes 2 days to settle. Okay, so I think on liquidity wise, as we spoke earlier, it's a massive market. Okay, so the daily liquidity is a very important characteristics. Next thing we talked about is accrued interest. This is something that perhaps unique to bonds as opposed to other asset classes. That if you would have invested in, for example, shares or managed funds, whether they pay, let's say, dividends semi-annually, or whether they make distribution every quarter, you have to hold your investments, whether it's equities or fund, on the ex-dividend date. For your entitlement to receive the dividends or distribution. If you sell out your positions or your investment before ex-dividend date, then basically you will not be entitled to. As opposed to bond investors, if you hold the bonds, let's say a fixed coupon bond that typically pays a coupon once every 6 months, 3 months into your last coupon payment day, and you decided to sell your bonds as you need liquidity, or you've decided to balance your portfolio, you want to take out money, or whether buying a house for whatever reason, you are 3 months from your last coupon payment day. You're still 3 months away from the next coupon payment day, but the interests are being accrued on a daily basis. So when you sell out your bond at that point in time, the buyer who buy the bond from you will have to actually pay you for the past 3 months that where you had to accrue the interest, but you have yet get paid. So this is perhaps to people like us works in the bond space, believe that it's fair to both buyer and the seller us that, because in another 3 months time, then the person who bought the bonds of you, that will be entitled to receive the coupon for the last 6 months. So I guess we often use an analogy that where you could compare that when you are buying or selling an investment property where there's a tenant already prepaid a month of interest, but the settlement happened in the mid-month, so that the vendor and the buyer of the investment property need to work out in terms of the entitlement that the vendor has to pass on to the next buyer. So in a very similar concept as you would like buy bond. So which I think is quite unique. And the next thing is where we, often we refer how, a bond's trading at discount, par or premium. So what does that mean? So bonds are typically issued at a face value of 100. Okay. So when a bond's actually trading at 100, we say it's actually at a par value. If you start trading below 100, that we often refer to as a bond trading at discount. Vice versa, if it's above $100, we consider that as trading at a premium. So I guess on the right-hand side of the screen, as a very, very, I guess for illustration purposes, if you have, looking at bonds that with a face value of 100 and it pays you a fixed coupon of 6%, if actually today, it's actually trading at $90, that means for the investor to actually buy this bond at trading at discount, you only have to pay $90,000 for a bond that has a face value of 100,000. Okay, so and the 6% of coupon is based on the face value, not the price you pay. So effectively, you bought a bond at discount that will give you a yield to maturity at a very simple rate of return, close to 7%. Okay, so again, on the flip side, if you would have paid more to acquire a bond, let's say you paid $110,000 to buy a bond with a face value of 100, although that you're still getting paid a 6% based on the face value, effectively you're paying a bond for at a premium, and your effective yield is around about 5%. Okay, so that, I guess, I hope give the audience today that a very basic concept that when you are referring to bonds trading at discount or premium. Okay, the next element again, I guess specifically applied to bond investors or the issuers or the actual bond itself, is you often hearing people referring their credit ratings, the AAA, the AA, or the triple Bs, the double Bs. So they are issued by those global credit rating agencies, whether Standard & Poor's or Fitch or Moody's. These are the three probably most well-known credit rating agencies. Although that they may have different convention in terms of using, the uppercase or the lower cases with, numbers, but they basically, the logic is the same. So when we often refer to anything is that triple B on above, it's considered as an investment grade bond. So, and when you are going down that waterfall, when you look at, things are trading at being rated as double B or single Bs, these are often referred to as a high yield bonds. And when you're getting into the C range, whether it's triple C or double C or single C, and people often in the market refer them as junk bonds, and which you might have read on the article about there are investors specifically looking at for opportunities in that space. Do we go lower than that? Yes. Okay. There's actually a D. D actually stands for default. So it means that if a company that couldn't keep up with its debt obligation, or they missed the coupon payment, then their rating will be downgraded to D, as considered as default. Okay. So so that's the rating in a snapshot. Okay. Move on. Now, we want to introduce the regulator for the deposit-taking institutions as part of this presentation today. Is that for most of the retail investors who actually started or new to the journey of bonds or look at a fixed income as an asset class, they're often looking at bonds that are issued by banks. Not just that they are household names. Is that APRA in Australia, we have a regulator called APRA, the stand for Australian Prudential Regulation Authority. They are the regulator that looks after all deposit-taking institutions and insurance companies. So that in Australia, we have this dual regulator mandate. One is APRA looking after the banks, insurance, and you have ASIC looking at other companies. So if you look at banks, they are being regulated both by ASIC and APRA. But from APRA's perspective, they want to make sure that our banks are strong and sound. They've got enough capital reserve, and they need to meet capital reserve adequacy ratio. So this is, I guess, especially true post global financial crisis. Over the last 15, 16 years, in every jurisdictions around the world, the banking regulators have all adopted Basel III framework and then continuously working with the banks to make sure that the bank have locking away more money in the safe, i.e. increasing the capital adequacy ratio. As opposed to that, a company, let's say a non-bank, we do have a number of a regular issuer in the bond market in Australia, such as Coles, Woolworth, even NBN, Ausgrid, infrastructure companies. They all come out and issue bonds. But the differences compared to banks and versus non-bank companies or corporations, APRA, and so do all the other banking regulators around the world. They perform stress tests on all the banks here. They do 2 stress tests a year. So, what does stress test mean? Means that the regulator will actually go to the bank and say, we'll give you a hypothetical scenario. What if our share market falls by 50%? What's your risk exposure? How much money as a bank you're going to lose? How much asset that you will need to write off? And if you do that, would you still have enough capital to survive? So that basically is stress test. So for all banks in Australia and abroad, typically the regulator would perform 2 stress tests on the bank, and the bank would perform 1 internal stress test. So scenario change, every time. So it could be 50% fall on the equity market, it could be 30% fall on the property market, or it could be exposures on digital currencies. So there are different scenarios being thrown in the bank every year. So as an investor, it's actually, I think that investors should take comfort that there is a regulator that actually I think applying that scrutiny, looking over your shoulder, ensuring that the banks are being sound, in terms of being solvent, and then they have enough capital to survive, or if the market goes into distress. So I think that explains why most investors, when they start looking at fixed income investment or in these asset classes, we will say that most of our investors that we have deal with started with banks. And while we're talking about why the banks are potentially safer, was purely because of the scrutiny that applied by the banking regulator. We should also look at it in terms of how the capital structure of the bank different to a normal company. In fact, they're actually the same. If we start on the right-hand side of the slide, of any company that their balance sheet or their capital structure, their capital stack are considered or are made of senior debt at the top of the hierarchy, and then you have subordinated debt. Then you go into hybrids such as convertible bonds or preference shares. Then you have common equity. So what does that capital structure mean, or this hierarchy means, is it represents the order of the claim. So we sometimes call it a claim hierarchy, or it's just a waterfall, where if a company goes into liquidation, then once they liquidate all their assets, they need to make sure that they pay out the senior debt or the senior creditors first. They have to actually make whole, i.e., they have to take all 100% of their credit back before you're able to go down that waterfall to pay the subordinated debt holders. And then once subordinated debt holders are being paid in full, then you go down to your hybrid, the equity or common equity shareholders that being the last when you go down that rank. So it's the same when you now looking on the left-hand side of the slide. It's actually the same as the bank that the capital structure are also made of senior debt, subordinated, hybrid, and equity. Now, as when you look at it into the senior debt, you have senior secured, means that there are collaterals that actually been specified in the loan or in the bond. Then you have deposit. Deposit is also considered senior unsecured. However, the government in Australia do provide a federal deposit insurance scheme. So every person and entity are covered up to 250,000 per bank. Okay, so they will rank slightly higher than the senior unsecured was purely because of the government insurance scheme. But if any amount that you deposit with the bank that goes over $250,000, you will fall on the same rank as the senior unsecured. And once you start go down that waterfall, then you start to hear people talking about tier 2 capital that actually represents basically is this. It's the same thing as you refer to as a subordinated debt, and then you go to the hybrid that's considered as an additional tier 1. And you go to your equity, which is the common equity tier 1 capital. So this terminology, I think, become more familiar with, I guess, the non-institutional investors that because they are often mentioned in the press or the media post-global financial crisis, because that's also the way that how the Basel Committee, that in their recommendation to the regulators and governments around the world, how they are proposing the bank can be better regulated if you have that segregation of your capital and you define them into different tiers, and how are we asking the bank to put up their capital adequacy ratio at a different level of seniority. Okay, so, and that was the big push that where back in the days, the banks are required to put up, 8%, 8.125% in the case in Australia as the reserve, as the capital reserve with the RBA. But I think post GFC, the banks are required basically, boost their tier 1 capital, their additional tier 1 capital, and so does their tier 2 capital. So the more capital reserve that the bank had set aside, basically is a sign of assurance to investors, especially the bond investors, because that the bank has locked away more money in the safe for the raining days. Okay, so if we look at that, the way that how the bank's capital structures are being, the capital stack's being structured, let's look at it as the investors that investing into a different seniority of the bonds or different instruments, how the investors are being compensated. So we use NZ as an example, and most of the major banks here in Australia are pretty much priced at a very similar level. So if we look at NZ, the 3 boxes on the screen now represent that the different seniority being senior, subordinated, or additional tier 1. So we list out basically most of the outstanding bonds that NZ have in the market. We use that, those dots that on the chart here basically represent how much more as an investor would get paid on top of the respective government bonds. So in the bond market, government bond yields is used as the benchmark. So if you're looking at getting into a 5 or 10-year bond issued by ANZ for the respective tenor, a 5-year government bonds or 10-year government bond, they will serve as a benchmark, and we look at how much more return that as an investor would receive as to compensate that additional risk. So typically, if you look at you're buying into an ANZ senior bonds, you're getting paid an additional somewhere between 0.7 to 0.8% in addition to government bond yields. So which means if we use I guess a 5-year government bond yields, for example, they're probably trading at about 3.8% return. So it's a senior bond in NZ that will give investor about somewhere about 4.6. Okay, and then you start go down that or go up the ladder, the return ladder, that for subordinated bonds, they are on average paying about 1.6 to 1.7% higher than government bonds, which you'll be looking at around about 5.4 ish in terms of where they're actually currently paying for, let's say, for 5 years. And then you go to the 81, they are probably paying around somewhere about 2.5 to 2.6% in addition to the government bond benchmark. So if you look at that, when you go down that seniority of the bank capital structure, seniors around 0.7 to 0.8, and then you get another 0.8% when you go to look at a subordinated bonds, and then from subordinated bond to 81, that's probably about another 1%, 0.8 to 1%. So in terms of the step up, okay, that represents additional risk that the investor should be compensated for. Okay, so if we look at this example of ANZ where the return is, and we want to use Macquarie because this is very, very new to the market. So we want to use this because they have the most recently issued, they're freshly out of the oven. So we think that it's probably more relevant to use them as an example in today's presentation. So when you look at Macquarie, this is a subordinated bond where this is actually, I think it was issued just last week on the 20th of August. So this is very, very new indeed. This one is paying a floating coupon. So they use a 3-month BBSW as the benchmark, and every 3 months the investor will get paid based on the BBSW plus a fixed margin of 1.85%. Okay, so right now, because they were just issued last week, the coupon for the first quarter is around 6.219%. Okay, so so the structure of this type of subordinated bonds is they would have a call date. So Macquarie structured this bond to have about 5.5 years. So what does a call date means? That means by the February 2030, Macquarie as an issuer, Macquarie Bank has the right to go to the investor and say, hey, I'm calling back that bonds, I'm going to return all your money. And why does the bank do that? Because think about it in a way that where like any of us want to refinance our mortgage, if the cost of funding become cheaper or there are other cheaper source of funding, the bank will definitely consider that, return the money to the lender, i.e. the bond investors, and then try to potentially issue new bonds. There are other technicalities that are associated with the call. That's also because in terms of the eligibility of the capital adequacy calculation start to evaporate in the eyes of APRA. So for subordinated bonds, APRA doesn't allow this to be, I guess, a very long term, i.e. they cannot be perpetual, and as the time that once the bond that gone past their call date, the amount that can be contributed to the capital adequacy ratio will start to decrease. Okay, so Perhaps we save that to our next presentation. But for typical investors, you're looking at this type of structure is that, if you start looking at subordinated bonds, that is something that you receive. Now, however, this type of bonds are not available on the stock exchange. So they're not on ASX. So they can only be traded as in the OTC market. Okay. So this is floating. On the same day of Macquarie, when they came out last week, issued that the Tier 2 or subordinated bond, they had two tranches. The other one we call as fixed to floating. So as opposed to the floating one you just saw, the Macquarie fixed to floating coupon, they actually pay a 5.6% for the next 5.5 years. That they'll pay you every 6 months. And on the same day, which is February 2030, 5.5 years from now, Macquarie Bank, as the issuer, has the right to call back. If they don't, and that this bond will actually convert into a floating rate bond using the same formula as you saw last page, and a 3 months BBSW plus 1.85%. Same margin, but that remain callable every quarter from that point onwards. Okay. Same thing, not available on ASX, this can only be trading at OTC. There is one special mention, I guess I should raise, that we're withholding tax exempted. There are this type of bonds. If you are not a tax resident of Australia, the issuer is not obliged to withhold tax for non-tax residents. It does not take away the responsibility of the person that to report their income to their home jurisdiction. Okay, the reason why they do that is there's a public offer test that being applied, and also because most of these bonds that not trading on XX, if they're trading in an OTC market, they are mainly held by a custodian bank. So the issuer doesn't have that visibility to know that which individuals actually holding the bonds, and whether this person, he or she, is their tax residents. So that's why for a lot of those bonds that are trading in the OTC market, it has that unique characteristics. So this is kind of a tier 2. I guess then if we go down that capital tiers, like we go down subordinate, and now we look at something we consider hybrid. Then we are looking at bank capital notes. So this is something that we're, again, very common around the world now, that where the bank will issue this type of hybrid instruments, or as an AT, additional tier 1 securities to boost up their tier 1 capital reserve ratio. Okay, so in Australia, there's a name that's considered the bank, I think there's a convention that we call the bank capital notes. So what are they? The reason why they've been called hybrid is they share, they have debt-like, they're also sharing equity characteristics. The areas that where they behave like a debt or a bond is they'll be issued at $100 face value, and they will actually pay a floating rate coupon that every 3 months. And by the call day, if the call being exercised, then the issuer, the banks, will pay the face value back to the investor. Okay, but where in the areas that where they're equity-like, in terms of what are the characteristics that they behave like equities. One, the distribution they pay out every quarter is not considered as interest payment. It's considered as dividends. So that's why they carry franking credits. Number one. Two, as compared to senior bonds or some of the subordinated bonds, the interest payments are typically cumulative. That means that if the issuer have difficulty of making a coupon payment, then all the coupon payment, that obligation, are being accumulated Okay, but typically, if they can't make a coupon payment, they consider default. But the obligation of that coupon will keep adding up. In equities, dividends are not accumulated. Means that if the bank that or company that have they may change the dividend policy anytime if they think that they need to preserve more capital or their financial performance is not meeting the expectation, they may decide to cancel the dividends. So when they do that, for the investor in capital notes, the dividends that the distribution they're getting basically is governed under the same dividend policy and share the same franking percentage as well. So being non-cumulative, if the issuer decided to cancel that dividend, then the capital notes investors will not receive their distribution. The other component is that they are also convertible. The way that the capital notes are structured is that there is a mandatory conversion mechanism that if the bank, the issuing bank's tier 1 capital ratio falls below certain trigger, as of now, most of them are being set at 5.125%. If it falls below that trigger, then the law gives the APRA or the banking regulator the right to step in and to actually take control and make decisions for the banks. So that is considered as a POMV, point of non-viability. So when, for example, APRA that deem a bank that a non-viable, i.e., they may not survive or they have difficulty of surviving as a going concern, APRA may step in and then basically took over all the decision-making power. So I think the most recent example that we have witnessed would be Credit Suisse that happened in March last year. So the Swiss regulator basically stepped in and decided that Credit Suisse has to be sold to UBS, and this is not up to the board or the shareholder to decide. The regulator has to be invested the power by the law to make that decision. And that is when those AT1 bondholders or security holders that faced the wipe out, and that was actually what happened during March last year. And so I think a lot of those investors that raise a lot of questions that would that actually happen in Australia? So unlike many of the early issues in Europe, while that there is still a possibility for the Australian bank capital notes are being completely written off, all our bank capital notes issued here in Australia has that mandatory conversion mechanism. That means that if APRA deem the bank that are going through a distress, i.e. that trigger that 5.125% tier 1 capital reserve ratio, then there will the way that it's been designed is the capital notes will get converted to common equity, i.e. you become a shareholder of that bank. But you will be, by the time you would imagine that the share price will be trading at a very low level. So the capital notes holder will be converted into an equity as an equity holder of the bank at the price that trading at the time. There's a calculation that were stipulated in the prospectus of the issuers. They will work out in terms of daily average across a time period to work out a conversion rate. Okay, so those are the things that why capital notes is a hybrid, because they share both characteristics of being a debt and equity. But I think most importantly is that we need to remember as the distribution that considers dividends, they carry franking credits, they're convertible if the worst case scenario happens. Okay, so again, you can see why we're using Macquarie, because Macquarie is the most recent issuer coming out in the market. They issue a Tier 2 bond. They also issue a capital notes. And this just came out last week. It's not even issued yet. The prospectus was approved and lodged with the regulator. They came out of the market with the book build, very, very popular. They issued 1.5 billion. Within a day, they received an order more than 3.5 billion. And for this type of instruments, they are traded on ASX. Okay, so that's why they are very popular among Australian investors, because there's not enough fixed income instruments that's available in our local market. So the way that is being structured is they pay a floating rate every quarter, and every quarter is based on the 3 months bank bill swap rate and plus the fixed margin of 2.65%. So this will be set on the issue day, which is on the 13th of September, and expected the first day of trading on the XX on the 17th of September under the ticker code of MQGPG. So likely, there will be probably, if we go by the most recent 3 months bank bill swap rate, probably around 4.35%, and plus the fixed margin of 2.65. As an investor, you should be expecting that the coupon for the first quarter will be around 7% mark. Okay, so and I think we mentioned that Credit Suisse event. It goes back to, I think, that we wanted to show you, what actually happened to its price behavior, given that they are traded on ASX. You can easily access that through your Tiger brokerage account. I think that also because due to the fact that Australia has a very shallow fixed income market, I think that I should have mentioned that earlier in my earlier slides. As an investor, a non-institutional investors, it's very hard for investor to access the fixed income products or investment opportunities. Given that, if I maybe go back a few slides, okay, maybe stay here. For the senior unsecured, they don't appeal to retail investor whatsoever. Why? Because their returns very low. You're looking at 4.5, 4.6%, and you go, who's going to buy them? In fact, institutional, like the banks, they will buy each other's bonds. So does insurance company. Why? Because they can use those bonds as a collateral to be given to the RBA, the Reserve Bank, so that NZ may buy Westpac bond, may buy NAB bonds, may buy bonds from CBA, and they may buy. So the reason they can't put their own bonds as a collateral to the RBA, but they will buy someone else's bonds and take that bonds to the RBA and do a repo. So, for example, if NZ issue a bond with $1 billion issuance, Westpac may come in and buy $100 million and take that bond to RBA and say, hey, I want to borrow $99 million out of that, so that you put NZ's bonds forward as collateral. And this also applied to some subordinated bonds as well, right? They have repo eligible. So that's why you can see that normally for senior bonds, they are really largely taken up by institutional investors or the banks themselves. Once you start to go down the ladder subordinated, then you start to attract some interest from high net worth investors. But still, I think 90% of the fixed income market are probably still in the hands of institutions. You have super funds, you have other asset managers. But once you start getting into the kind of the 5 to 6% of range, then you start to get more and more interest from a different part or segment of investors. But unfortunately, they are still not accessible by retail investors on exchange. So they trade in OTCs. Really start getting to that blue box of 81, which is the capital notes that we're referring to now. They are being listed so that even retail investors can access them once they go, once they start trading. Okay. So, and again, that people's going to wonder that, okay, we talked about its seniority in terms of the risk, in terms of whether they could be converted to common equities. How do they behave when they go through stress in terms of the price behavior? So if we look back in terms of, over the last, 4 or 5 years, the really period that we saw that the market was in distress was during COVID, March 2020. And all those lines that you see are the hybrids or capital notes that are issued by the major banks. They actually, at the time, they're trading below 80, about $80. Remember, they have a face value of 100, but they soon recovered, within the time about a month. So even when Credit Suisse happened, in terms of the forced takeover that we talked about earlier, back in March last year, we see actually very little movement or to the price of our capital markets, our capital notes in Australia. I think that it's also due to that our banks here, if you look at this line, represent the tier 1 capital reserve ratio our banks has been building over the last 8 years, that was from below 10% to where now average between about 12 to 14%. So the more capital reserve ratio the bank kept aside, obviously it means lower risk for investors. And if we put our banks, this is actually taken from a CBA's financial in terms of their announcement, their presentation going back last year. If we put our Aussie banks across in comparison with all the major players, our banks actually carry a much higher CET1 ratio compared to its global peers. Okay, I think that also, I guess it also explains that where our banks are simpler banks, unlike some of the gigantic global universal banks that they may have a very different business model, but our banks here tend to have a more simplified risk exposure. Okay, so this chart, we wanted to show you that this represents the entire universe of all capital notes that are issued by major banks, and all those ones are ones that they actually, it's probably less than 30 of them that where they are currently trading. And when you and this chart is trying to represent that on the left hand side, it shows basically the price of how much they're currently trading, and across the x-axis, this is basically vintage, from the left hand side being the most recent issue, and then to all the way to the far right hand side being the ones that are being very close to its first call date. So across all the different vintages, you can see that where all of them are trading above 102, and across different vintage, obviously they pay different margin. And I think that represent the different the time of issuance at the current at the prevailing market condition. So some of the older vintage actually pay a higher margin. So the other way of representing that the chart is that we plot based on the price and the issue margin. You can see that that obviously the higher the margin they pay, are being more favored by the investors, that investors are willing to actually pay more for those capital notes that actually can pays our higher distribution rate. Okay, so the other reason I think that we mentioned earlier is that that's also because that the fixed income investment opportunities are the supplies are very limited in Australia, so that also present that scarcity, that where only those the ones that fewer than 30 of them are listed on the exchange, where there's a lot of retail buying demands, that once they're listed, there's a lot of investors that will buy in them up. The chart that we have in front of you basically show you for the most recent issues that going back the last 8-9 months, how have their price that being has been behaved. So I think most of the issues that you can see that the price are gradually being bid up. So I guess a quick final recap. I think that today, we've been very honored to take part of the Tiger Live stream webinar, and I think that with Jack and his team, we want to be able to provide that facility for the eligible wholesale qualified investors kind of be able to participate. So please feel free to reach out to Jack and his team, and for some of you that may be interested in taking part of the Macquarie Capital Note 7 issuances. The issue day, I think that the allocation application are right now well underway. Interested investors can actually go to their official website to download the prospectus. But if you need any help, please reach out to Jack and his team. We're more than happy to facilitate the applications and ensuring that the suitability and the adequate advice have been given. Okay. That's it.
Thank you, Alan.
How do we time?
Yeah. I think we are really well timed. So we still have 10 minutes. And I think we received some of the questions from the audience. So one of the question is, so what's the condition or the event that a hybrid will convert to equity again? Could you say that one more time? Yeah.
Sure. So there's something that referred by regulator called a hard trigger. Hard trigger means 5.125% of their Tier 1 capital reserve ratio. If the Tier 1 capital reserve ratio fall below 5.125%, then that mandatory conversion mechanism will kick in. But that can only be mandated or forced or instructed by APRA. There are other soft triggers that where, for example, we mentioned about stress tests earlier, right? I think one is, you guys can Google it. APRA and so do other regulators around the world. They do publish stress test results. Okay, so I think so far, it's more like kind of name and shame type of approach. They will say that, okay, ABC Bank may show sign of weakness or being requested to redo their calculation, or certain part of the business show some sign of weakness. But from from any negative observation to kind of any soft trigger, that really comes down to the assessment of the regulator where they deem the bank as non-viable. So the point of non-viability is a PONV event. There are obviously that hard trigger of the capital reserve ratio is the most important thing. But if there are other areas that where the banks start to concern, so for example, if we use the Credit Suisse as an example, although that at the time they may still have adequate Tier 1 capital reserve, but the regulator in Swiss has taken a very stringent and conservative view that they basically made the assumption that some of their risk exposure, if they want to if the bank basically could not recover some of its bad loan, for example. So by pricing in those scenarios that may lead the bank to go below that trigger, then the regulator may be forced to act early. So if you may find it's very vague, I guess in all scenarios that where the regulators invested the power that to actually protect investors, to protect the integrity of financial market. That is actually the fundamental logic behind all this, Basel III framework, and why Australia and all, plus other 170 plus countries that adopted the Basel III framework, and they're now slowly moving to Basel 3.5. where it's more about ensuring that the bank are well capitalized, but also giving the power to the regulator to supervise and also to step in. So yeah, so I guess there's a very clear, I think there's one section in the PDS for all the bank capital notes that actually explains that, you know, when that happened, then how the conversion mechanism would work.
That's very helpful. And also, as you mentioned, the Australian banks, generally speaking, they are more resilient compared to the other banks in the world, right? So, I guess I think it's fair to say that generally speaking, the trigger event is probably once per blue moon, or probably like not a very likely happening event. Of course, we can't say that it won't happen. However, having said that, the likelihood of happening at this current point of time, according to the public information, should be fairly low at this stage. Am I right to say that, Alan?
Well, I guess we can probably draw, again, I'll probably go back to that stress test analogy. Some of the scenario that perhaps we talked about earlier in terms of a 50% fall in share market or 30% fall in real estate market. That was the actual scenario given by regulator for the bank to perform. So even in that, under that stress scenario, the bank can still pass the stress test. So I think that is, you know, I think that we can take comfort. I think more to do with you know, that regulator, probably going back to my earlier point, the reason why we have this, you know, APRA looking over our shoulder is actually to protect investors. And I guess to your point, Jack, I think our banks that do very well in Australia, and also because of their business model and their risk exposure, our banks don't do very well when they go overseas or when they try to compete with other global giants. But Macquarie is probably the exception. Our big four are, you know, more into the traditional, I guess, banking, lending. Macquarie probably have a more diversified lines of business compared to the big four.
And also, I would like to mention that there are certain benefits to being a qualified investor. So any of the audience, or when you viewing this webinar, you believe that you are a qualified investor, please reach to us, and then we will regularly update you about the latest opportunity on the upcoming initial public listing of the hybrid securities of the capital notes. So therefore, you can you'll get a first hand on these sort of instruments. And I also got another questions from another client. What's the difference between buying hybrids on ASX or from the prospectus, assuming I'm a wholesale investor?
Okay. Okay. I think I should perhaps make it clear that if we use this Macquarie Capital Note 7 as an example, the issuer under their design and distribution obligation, the target market determination is that only available to the wholesale investors or any retail investors that receive a personal advice from their financial advisor. So only this two group of investors are qualified to participate in the IPO process. The law had, or I think the regulation had largely changed from, you know, years ago. If you go back 4 or 5 years ago, you know, any retail clients can download the application, the prospectus PDS, and fill in the application and send it back to the issuer. The regulator has stopped the banks to do that. Not just capital notes, but there are a lot of those IPOs or placements that are now being considered as only for wholesale clients or retail investors receive personal advice. Okay, so I think I should make that caveat that not just about wholesale investor, but even if you are a retail investor, if you receive the personal advice from financial advisor, think that is suitable for you, then you're also allowed to participate. Okay. I think second part of the question, Jack, is what's the difference in terms of you fill in application form from that on the back of the PDS. Technically speaking, there is no application form now on the back of the PDS anymore. Also because of the change of that target market determination, so that you really have to go through a syndicate broker or qualified advisor that will actually help him to participate in that process. Having said that, the settlement, there are multiple settlement methods that where a client or investor, interest investors that can participate is you can, for example, being a type of a client, use your Tiger Chase sponsored account to as the settlement as the account that to receive to actually perform the settlement. Apologies. Or you can also tell the broker, for example, ourselves, say that we could use an issuer sponsored. So that basically is an option that where we will fill in the application directly to the issuer, and where they will use their share registrar to hold the records for those investors that, for example, computer shares or link services, right? So obviously from our, I guess from all our experiences, it's very, very unlikely that people are going to go down the path of using an issuer sponsored route. Especially I think to today's audience that where most of I would imagine everyone will already active Tiger clients. So I think the settle into your Tiger brokerage account is the most flexible and easiest way. So yeah, there's no direct application to the issuer now. You have to go through a syndicate broker.
Yeah, I would like to add to that as well. So generally speaking, so when people subscribe, it's kind of like subscribe to the IPO. So when investors subscribe to IPO, the price of the instrument is $100 when people subscribe to it. So however, because the yield is fairly high, so compared to the general yield potentially get it from some of the market, and therefore people will bid up the price, will buy it, because generally speaking, people won't get enough on the from the IPO stage. They won't get enough. What they for example, they want like maybe $100,000 worth, and then they probably only get like $50,000 worth, and that's why people would have to buy it on the secondary market. So actually bid up the price. So it bid up the price from $100 to like $102, $105 within certain period of time, and therefore as the price bid up, the yields go down. So what that means is, if for people who buy on the secondary market, if don't go through the primary market, go secondary market, the price they maybe buy at a premium, so more than $100 face value of the capital notes. So what that means is the investor participate in the IPO of the capital notes of the hybrid securities would get that particular portion of funds would get higher yield compared to if for people buying on the secondary market.
Yeah, absolutely right. Right. So I think that that's what we probably pointed out in that earlier slides, that where I think one, during the IPO process, for example, like what we talked about Macquarie, there were more than 3.5 billion worth of order that people want to apply through all the different lead managers. but they only end up issuing 1.5. So across the street, that amount that we were bidding, ourselves included, will scale back to average about 33-34%, i.e., if we had bid 400 million, we only being allocated about 33-34 million worth of the notes. So that's why the demand outstrip the supply. To Jack's point, once those notes are listed, you still have a lot of people that want to buy more. So that's why they start coming in the market and bidding them up.
Yeah, and also, so to be a qualified investor, there are quite a few conditions, one or the other. So the first one could be like the investor have more than 2.5 million of net assets. So that means the asset minus the liabilities, the equity part is more than 2.5 million. That's one conditions. Or annual income more than 250,000 for 2 years. So for 2 past financial year continuously. That's the second condition. Or investor with single investment invest more than 500,000. So that is also a conditions. So and also this condition could potentially be changed later on. By the time you see this webinar, the condition could be changed already. There are consultation in the with the regulators that they are consulting about it at the moment. So it could be changing going up afterward as well. So that also means like if you think that you are eligible for as an eligible investor, please feel free to get in touch with the Tigers team, and then we'll get you basically qualified, and then we will have continuous qualified investor opportunity sending through to you for you to consider for your future opportunities. And yes, that's very important. I think we are a little over time now, Alan. Very informative, and thank you very much for helping out and explaining these the fixed income instruments. And yeah, so and then we'll get in touch, and then we'll take it from there. Thank you.
My pleasure. Thank you.
Thanks, Alan.
Thanks, Jack.
Thank you.
Thank you.
Bye.